Gagan, and you're listening to the Voice of Insurance podcast, produced in association with Advantage Go, enabling an enterprise view of exposure. Today's episode is special and completely out of the ordinary. Regular listeners will know that in most episodes, I'll talk to senior insurance and reinsurance executives and focus on what they've just done and what they're about to do. Today is no different in that respect, but it's a far richer encounter because of who my guest is and what he has been doing since the summer of 2023. Until very recently, Steve Arora was the co-founder of Alpine Re, a new balance sheet reinsurer looking to tap into a disrupted reinsurance market. Alpine Re didn't end up materialising, but only after an intense 20-month period of activity in which investors of all shapes and sizes were contacted and canvassed. All this means that Steve is currently better qualified than even the best investment banker to talk about what investors want from the reinsurance industry. Once you've left no stone unturned, you get to see the real layout of the bedrock below. And in our interview, Steve goes really deeply into the appetites, hopes and fears of each investor type. We also examine in great detail the optimal design of the model reinsurer of today. If you had a blank piece of paper and could start a new reinsurer from scratch, where would you be domiciled, and how many underwriting locations would you have? And what would you be looking to write? Would you be a specialist or a generalist? And what would your relationship with technology be? Understandably, Steve has been thinking very hard about all these questions, and his insights are highly valuable. This episode is a great illustration of how no experience ever goes to waste. Steve is on excellent form, and the interview has great pace and intensity. In our world, very few people try something genuinely entrepreneurial more than once in their careers. And in this meeting, you'll learn all of the lessons that Steve has learnt from time spent a long way out of his comfort zone. It's clear to me that the next role or venture that Steve becomes involved with will benefit immeasurably from this recent intense experience. In the meantime, I can highly recommend a listen. Enjoy the podcast. Steve, welcome back to the Voice of Insurance.
Thanks for the invitation.
Just before I hit record, we were just trying to remember, when was that first podcast? It was one of the earliest ones. I'm not sure if it was still in single figures then. It was well over 5 years ago, and you were at Axis Re. Obviously, lots changed since then. The last couple of years, you've been trying to build a venture, Alpine Re, really interesting, a de novo reinsurance balance sheet underwriting entity. Tell us all about it. When did you get the idea for it? When did you start trying to get involved in it?
Yeah, well, look, we took a swing. It was tough macro conditions overall, and we just couldn't drag the deal over the finish line. But it was tremendous learning, and I'm really happy to share some of my insights with the community. So we started in the summer of 2023. The conditions had experienced a material step change in the industry. I personally had the time and the energy to go for it. And my view is I always had a dream of building a company. So if I wasn't going to do it now, then when was I going to do it? I had the honor of aligning myself with a mentor of mine, Willie Zeller, who agreed to be a co-founder, and off we went. So it was a new company formation, a strategic entry into the heart of the dislocated reinsurance market, and also a very interesting investment environment. The headlines is we were trying to seek $1 billion of capital for an A- rated balance sheet with a Bermuda domicile, and we are supported by great firms.
How long have you known Willie? It was really nice to hear his name mentioned. I think he'd been out of Hanover Re for, I don't know, about 8 or 9 years by that stage.
Yeah, so Willie and I met when he was on the board of Axis. I was the CEO of Axis Re, and we instantly formed a great relationship. He was the resident expert on reinsurance on the board.
All right, so you had a natural affinity with each other.
Yeah, I think there was very strong alignment. We both grew up in European reinsurance environments, so we spoke each other's language and kept in touch ever since. And I think we had a mutual respect. So when I called him to first position the idea, I was a bit nervous he was going to say no, but took a couple of days and came back, and the rest is history.
It was a nice moment to hear his name mentioned again, because I kind of missed him from his time at Hanover Re. That was always a fun time, and he was always, I don't know, he had a big personality, I think. As from a journalistic point of view, I like that about someone, when obviously they're not scared of speaking their mind, and they've got opinions on things, and they're happy to share them with you, and they've got good reasoning behind what they're doing. You know, I always thought that was really interesting.
Yeah, I mean, tremendous track record, a great partner, a great mentor, someone who's taught me a lot about the business. And yeah, it was a great experience working together with him.
Did you have a big idea with the business? Obviously, the market opportunity was really obvious, I think, to anyone as 2023 was developing. And certainly by the time it got to Monte Carlo, I remember doing a podcast down at Monte Carlo, kind of documentary roundup of everybody I'd met at Monte Carlo. And it was so obvious to me that the market was really finally cracking and changing. And there was a certain amount of fear out there that people might not get their programs home and that kind of thing. So that thesis was obvious. Was there anything else that obviously, when you get a chance to start a reinsurer from scratch, you get a chance to do something slightly different. Was there anything of that other than the obvious market opportunity that you had?
We knew the reinsurance conditions and the investment environment were really strong. We also knew that it was going to be extremely difficult to raise the capital, but we thought that it was worth an attempt.
It's only an opportunity if it's hard, isn't it? Because if it was easy, then there wouldn't be an opportunity, I suppose.
Yeah. And so our investment thesis started with the fact that we thought the P&C reinsurance sector, and we still do, has exceptional attributes for investors. I mean, it's global, scalable, there's low investment correlation. You can have a significant investable base without borrowing costs. It's annually renewable, so you can respond to shocks and interest rates and inflation, et cetera. So the sector is really strong. The second thing was around the timing, and we felt it was the greatest time to be investing in the P&C reinsurance space since 2001 because of those three elements that I talked about. The underlying insurance conditions had come off of dozens of quarters of compounding rate increases. Reinsurance experienced that material step change, and the interest rate environment was really, really strong. So when we think about how do you enter, the preferred structure for us was build over buy, because the clean balance sheet, both assets and liabilities, and the clean operations allows you to build something really modern without some of the drag that you would have from previous underwriting years. So we set out with a nuts and bolts plan, very focused on the fundamentals, which was not chasing trends. And everything that we did, the ethos was rooted in consistent book value growth. So we had a lot of attributes to our plan, but ultimately it was a fundamentalist play.
And I suppose, of course, when you start, you can build a platform and you think this is going to be the most efficient platform. Of course, when you're in a legacy carrier, you end up with, oh, I've got a thing over here, I've got a balance sheet sitting over there, and I've got something else. And you end up with a whole load of things that are not necessarily the most optimal collection of balance sheets and platforms. I suppose when you're starting anew, you can just say, right, it's going to be in Bermuda and that's it, or it's going to be Lloyd's only, or it's going to be something in Switzerland or whatever.
Yeah, I mean, I think it starts with the underwriting strategy. So for us, it was very focused and selective, 10 lines of business, only in mature markets. We feel that there are many products and markets that just have very low rate adequacy. And just by not doing those things, you can optimize profitability for your portfolio.
So it's just stopping doing the dumb stuff.
But also, there are certain lines of business that we really liked. We thought were positive contributors to the portfolio. So it's optimized for profitability. We wanted to do everything in one location or maybe two locations. So it's a centralized model. But everything that we set out for was product-centric, portfolio-minded, and very return-oriented. And you can go with a low volatility strategy. You don't need to anchor towards previous exposures. We wanted to do everything on an outsourced basis to the extent possible. So that leads to a very competitive cost ratio. And when you build a platform in 2025, it's very modern and there is no legacy infrastructure. And therefore, that leads to something that's really, really attractive. So, of course, all the investors worry about ramp up risk, de novo risk, startup risk. But when you have an experienced team and a proven playbook, and you've been at it for 18 months or so, you mitigate a lot of those risks. And of course, the financial profile we felt very confident in.
When did you really launch and say, right, we're really on this plan officially? And you sort of probably put a business plan together, got a name, that kind of thing. When did you say, right, follow me and take up your...
Yeah, it was the summer of 2023.
And how did it go? What were those initial meetings like with investors and potential partners?
Yeah, well, what we were told when we started was PE is closed. And what I can confirm to you is that PE was closed and, PE continues to have struggles with this type of proposition. And I think the first thing to focus on is the higher interest rates. That created a lot of headwinds because ultimately the PE firms have less liquidity. They can't recycle their capital back to their LPs. And fundraising is difficult. So the bar just gets raised very, very high for any new allocations. And it's very, very difficult to raise, an anchor investment of 250 to 500 million from a brand name PE firm in this type of environment.
How far did you have to go, and how many people did you talk to?
Well, we spoke to a lot. Obviously, you need to navigate towards different pools of capital. I mean, just to finish the PE story, because I think it might be interesting to everyone, because the bar was raised so high, I think the PE firms and other investors look to different areas to invest. So there's a huge interest in capital light models. These require a smaller check size with much higher EBITDA multiples in the current environment. So that was one popular place for the PE firms to invest. And then everybody loves life and annuity businesses today to replicate Apollo's model with Athene and Athora from several years back, because it gives you strong investment leverage, much higher than P&C, and that becomes an asset gathering strategy, which becomes very attractive. I mean, clearly, the second thing, other than the interest rates that were a real challenge, was how do you plan for the exit? So PE firms and other investors want to achieve multiple expansion by exiting in 5, 7, 10 years, whatever the horizon is. And despite our very conservative assumptions and PE style returns that were very compelling, I think recent data points haven't reinforced confidence in terms of either IPOs or other formations that haven't exited or at 1.5 times book value. So the higher interest rates or the higher bar, the liquidity issue, and planning for the exit. And then, of course, there's many alternative ways to put risk-bearing capital to work these days in the market, like sidecars, multi-class sidecars. And these are self-liquidating structures where you don't need to plan for an exit.
Absolutely. And there's almost been a proliferation of different ways of putting capital to use. So almost at every platform, I mean, we're sitting in London, certainly in Lloyd's, there have been many different innovations and all sorts of things. So where did you find with success when you were knocking on doors? Where were you most welcome?
So as I mentioned, you have to navigate towards different investor types. So pension funds, we didn't really feel showed a big level of interest in this trade. We did engage with family offices, but they're never equipped to lead a transaction, and not much action with high net worth individuals. However, the two investor types where we had the most success were asset managers and sovereign wealth funds. So both of them are more permanent capital in nature and don't rely so much on the exit. So that's helpful. On the sovereign wealth side, I mean, clearly a P&C reinsurance type of trade adds to diversification of existing holdings. In most situations, though, those sovereign wealth funds were seeking a blue chip PE lead to help anchor the deal, to provide confidence and expertise. I think on the asset manager side, everyone today is interested in insurance as an asset gathering strategy. So many private credit managers out there that were not doing life and annuity or tried to complement that with a P&C strategy oftentimes felt that something like this could accelerate their private credit strategy. So those are the two pockets where I think we had the most success. I mean, we did engage with many professional PE firms, got close in some instances, but sovereign wealth funds and asset managers would be the other pools of capital where we spent the most time.
Obviously, this has been a long period. It's almost like when you go to university, you've got 3 or 4 years. You've done a couple of years in this particular university, this University of Life, of trying to start up a reinsurer. What do you think you've learned most in that time?
Probably my biggest takeaway is that the operator mindset and the investor mindset are fundamentally different. And I think successful businesses, you need both skills to generate the kind of success and returns that you're looking for. But generally, people who participate in this industry have one or the other. So I think it's a powerful combination when you're an operator, but you can really understand value creation. Typically, operators focus on the products, the markets, the teams that need to bring it alive, the franchise, client relationships, operations, etc. But when you're in the mindset of the investor, it's all about value creation. So what's the right model? How can you make your capital most efficient? What's going to generate the best multiples? So I would say that is probably the biggest personal takeaway for me. I think in addition, there needs to be a hook when you build a business plan and you raise capital. And everything we did was grounded in the fundamentals because I still to this day feel that we focused on all the aspects that are going to make you either win or lose with this sort of proposition.
It certainly is interesting. We're sitting in Q1 2025. The Q1 results 2025 are coming out, and they're nearly all out now. And no one's saying the reinsurance market's no good. Everyone's saying it's great.
Yeah, but in such a competitive fundraising environment, you need to have sizzle. So something that's forward-looking and gives the investor a feeling of scarcity. And one investor gave me some advice to say psychology trumps substance. And it's true in a lot of ways. And I think if there's one thing I look back on, which we could have done a little differently, is added more sizzle to our business plan that would have given the impression that we had the world's best algorithm for underwriting, or we're going to be the first and only to implement AI.
So you think you should have been more sensational? I suppose
A little
you
bit,
were going
yeah.
more in conservative. I don't want to overpromise anything. I'll overdeliver later.
I think we focused on the fundamentals. I support the business plan that we authored. It was extremely thoughtful, but being self-critical, I think we could have over-rotated and sold a little bit more some of the aspects that are important, but are probably not at the top of the list.
It's still a pretty good reinsurance market now. It's probably just past its peak, but it's still very good in a very good place in terms of rate adequacy and demand. Obviously, there's still plenty of demand. Would you say that that window of opportunity is now closed? That window of opportunity to start a new reinsurer from scratch?
I think perception would lend itself to yes. I think reality is no. And the reason why I say that is back to the operator versus investor mindset. The typical operator would say, well, rates are coming down, and therefore this is not a good opportunity to start a new reinsurer with a clean balance sheet. The reality of the situation is that even with a low 90s combined ratio, generating just a 10% return on the ROE from underwriting activities, the investment side of the equation could add significant accretion to the ROE to get
Absolutely.
you to something that's 20 or 20 plus. And if you do that on a consistent basis with low volatility, that's a pretty good business plan. And so this whole value creation aspect, I think I can't reinforce enough that it's not always correlated with the way operators think about market conditions. Now, in terms of the reinsurance market, I think it's actually in a pretty good place. Results are good. Pricing is decent. Terms and conditions are also strong and take much longer to change than the actual price. The market's disciplined. There's a lack of capital reentry, and there's limited competition in P&C Re. I mean, it's a very large market in terms of 700 to 750 billion of capital, but really only about 15 to 20 credible names in the P&C reinsurance space. And I think everybody's done a great job of not only paying claims, but keeping their costs low. So I think from that point of view, it's in a decent place, but there are still challenges.
In some ways, there's never a good time and there's never a bad time to start any kind of insurance venture, because if you spent the whole time waiting for this perfect moment to kind of launch your boat, wait for this perfect calm sea in which to do so, or the following wind, you may wait a long, long time. And in fact, probably the best time to start an insurance venture that you've got in your mind as a good venture is now.
Yeah, I think the industry and the sector have very strong attributes for investors. So almost you can look at it as you're going to have more or less success based on the way capital is flowing in the investment community.
What would you do differently? You said you'd probably sell a bit harder. You'd promise a bit more. What else?
I think that's the main thing. I think no regrets on pursuing the opportunity. I'm incredibly grateful to the people who have been involved. So tremendous co-founder, a team that showed a lot of grit and tenacity and resilience. Not every day is a good day when you're raising money in this environment. And we had an incredible group of partners who stood by us along the way. So that went well. I think being self-critical, I think we could have tweaked our story probably a little bit, added a bit more the elements that way people were looking for. But I have no regrets on pursuing the opportunity.
It was quite gratifying when you start a new venture, and I suppose it doesn't feel sometimes that you're just about to throw yourself off a cliff, but you make that leap of faith and you throw yourself off the cliff and you find out all sorts of people are there to catch you, or they're there to look after you, and you find out who they all are, which is a good thing.
Yeah. So, like I said, aligning yourself with the right people who you can trust and lean on makes a big, big difference.
You look at the world of insurance, great amount of opportunity, loads of new business, new classes developing, great opportunities, demand all over the place. What would you like to do now? If you could write your own ticket, where would it be to?
Well, I think once you enter the space of trying to do something entrepreneurial, you get a little bit rebooted. So I would love to do something that has a value creation element to it, something a bit smaller, building. And there's a lot of things I've been exposed to now that wasn't really on my radar before. So there's incredible structures out there about how you can put risk-bearing capital to work, working alongside investors, asset gathering strategies, et cetera. One thing I think is a big opportunity, it sounds super old-fashioned, but the good old diversification benefit between life and health and P&C, obviously the large reinsurers have that model.
Yeah.
But I think there's a lot of interesting things that can be done because you can fund completely different side of your balance sheet by just adding one of those classes to your existing platform. And we haven't talked about AI and machine learning, but this is something that also, from building a platform from scratch, I was really exposed to what can be done in that space. And I think there's a big opportunity there.
I mean, the other great thing about having no legacy, if you've got no financial legacy, you've got no cultural legacy, but also you've got no tech legacy, which is so important these days. Where do you think we can be going with AI? Because, of course, you come in as a potential new customer, talking to everyone, saying, well, what is the best thing I can have? Particularly looking as an outsourced customer, saying, well, what software as a service can I buy these days? Now, I think these days you can run an insurance company or insurance company completely virtually. You don't have to be in charge of any of that software yourself. You just have to pay the subscription fee.
Yeah, I mean, I think one thing is when you start from scratch, there are just many excellent firms out there that are doing great things that you can plug and play into a very smart and thoughtful operating model that you construct. And you don't have to worry about the costs associated with a legacy system or teams that you have in place. You can just design it from scratch. But I think looking at the P&L, the first item I would focus on the most immediate is the cost efficiency. So there is a significant ability, and a lot of people are working on this right now, to streamline operations. You can look at your submission process. You can automate how you ingest data. You can triage your transactions, all in a way where you have leaner teams and reduce overhead. And then decisions can be faster. You can evaluate deals quicker. You can get back to brokers in a more timely manner, and everything can be cloud-based on day one. So the cost line item, I think, is immediate, and it has potential for big impact. I think a little bit further out, but not too further out, is the loss ratio. So this is the underwriting, and how do you get better risk selection and portfolio construction? And
that's probably phase two, would you say? Because we've got so much low-hanging fruit to crop straight away. You might as well have that.
Well, I think there's just really interesting things like identifying hidden patterns in cedent portfolios. You can improve your loss ratio. You can reduce the bias you have.
And obviously, you can be a great reinsurer partner. They won't always like you for pointing out some things that they've got wrong, but they'll thank you in the long term. And they'll say, well, that was great that you spotted this thing. We hadn't been aware of that. And now we're checking it out. And actually, that's good for me. It's good for you, right?
Yeah. And you can have more consistency in your decisions, and that can be more repeatable. You reduce the bias. And portfolio construction, cycle management, I mean, creating a strategic liability allocation that's matched to what your investor commitments are, identifying the correlations in your liability portfolio. All of this, I think, is coming. One area, the third and final area, is the investment return, which is often not discussed. But in terms of either A, asset allocation, or also systematic selection of the assets that you match to your liabilities. I mean, we oftentimes put risk into baskets. We say it's U.S. currency, U.S. denominated style of risk. Let's go out and buy a U.S. Treasury for the same duration. Done. But there are probably other things that you can do to increase the yield and get a competitive advantage. So I think the cost ratio, the loss ratio, and the investment return, if you think about your P&L, are the three areas where I think AI will have the biggest impact.
I suppose things like claims as well. I mean, you handle your claims and you're looking at the different strategies that you deployed on different claims. And now the AI is kind of cataloging all of that and saying, it can start recommending that you do something. They say, well, look, 99% of the time, if you offer to settle right now, you're going to be happier than if you fight it. For example, those kind of things. That must be really interesting. You can trim the loss ratio and also presumably make your customers happier with you, that you can deal with those claims quicker.
Agree.
In terms of doing things differently, you mentioned about PE being on strike. Of course, it's not on strike in terms of it's still in love with fee-earning businesses, capital-light models, and some of the hybrid models and things. If you were to do something differently, would you be looking at that and saying, well, you've been saying that you would like that value creation, that balance sheet, but these days, in the way that we're talking in this technological world where we can outsource all of our technology, and I'd say my theory about this is that if we digitize the insurance and reinsurance value chain all the way from the original customer all the way up to the capital markets, then it allows each part of that chain, the broking part and let's say the underwriting part particularly, the skills there to be disconnected from the rest. You don't have to be connected to the balance sheet anymore because it could be just as efficient because you can have all those systems. You can be a virtual insurance company, just don't happen to be the person providing the capital for that. And so what we're effectively doing is we're isolating that underwriting skill. So you can say, hey, I'm a good underwriter, so now I can just be paid for my good underwriting and I own the equity in that very important part of the insurance value chain there, where actually I'll be owning probably the lion's share of where the real value is. And so I can own my own skill in underwriting. That's a good thing to have. So what about that? Doesn't that appeal to you to say, hey, we forget about the balance sheet and all that other stuff and dealing with rating agencies and things. Why don't we just focus on skill of underwriting?
Actually, one thing I haven't mentioned is we actually did test the MGA model through our journey. And here's what I would say. First of all, the reinsurance MGA, there's a reason why not many exist today. And the reason why is when you add another link to the value chain, it's hard to make the economics work for everyone, but you need paper. So the way to bring in capital to support you on the underwriting side, the risk-bearing capital, more or less is in the form of sidecars.
Yeah. So you do need that balance sheet.
Or you need somebody else's paper,
yeah,
which adds costs into the equation. So here's what we experienced. On the casualty and specialty side, there was a lot of investor interest, but there weren't many willing parties willing to offer their paper for us to make that work, despite the economics. And the reason why is that fronting company would have to take the tail risk, the credit risk, and the risk to the investment strategies of the investor who's participating in the sidecar. Okay, so on the casualty side, plenty of interest in the capital, long duration, asset gathering strategy, something that's quite popular at the moment, but hard to find a front. On the property side, we had plenty of people that were willing to front because it's shorter tail in nature, and some of the aspects that I mentioned for a fronting carrier is just a little bit easier to digest, but the capital to come into a de novo MGA model to deploy cat capacity wasn't as strong. So capital on the casualty side, hard to find a front. Property, easy to find a front, hard to find the capital. And, it's just unnatural to add another link in the value chain. I mean, MGAs more broadly, I understand the capital light nature, and I also have seen that they've offered very interesting multiples over the past several years. I think there's too many. The premise of having MGAs in the market is specialization, and I see that being diluted with the number of MGAs that are forming, and it's just too much cost in the value chain. So I expect over time that there'll be a correction, that the best shops and the best underwriters will clearly succeed. But I view it a little bit as a herd mentality where the capital light models are being funded because they're a nice investment story, but long term, I don't think they're sustainable.
You spend a lot of time looking at the reinsurance market and the insurance market. Having spent all that time studying the market, where are the best opportunities, do you think, in terms of which classes and which geographies?
It's interesting to think about casualty because on one hand, I think it's the biggest challenge, U.S. casualty at the moment, but I also would probably characterize it as the biggest opportunity. So in terms of challenges, I mean, we know that the underlying dynamics of inflation, whether it's financial inflation, social inflation, the plaintiff-friendly legal systems, the rise of litigation funding, nuclear verdicts, I don't think it's 100% behind us. And I also don't think that the economics of the reinsurance transaction, i.e. where ceding commissions are, et cetera, are in a place where you would say that this opportunity makes complete sense and the economics have a high level of confidence to the pricing. So I expect more pain to come through the system. I mean, clearly many companies have studied this carefully. There's been a lot of reserve strengthening across the entire industry, but I wouldn't be surprised if there isn't a little bit more in the future. That being said, I think we're at an inflection point. And I think what's required is a lot of discipline and good companies that continue to be driving rate on the front end to keep the limits contracted and for reinsurance ceding commissions to come down and interest rates to remain reasonably healthy. And then I think casualty is a very attractive opportunity. So it's a tough one right now to call. I personally think we're at an inflection point, but that's probably the single biggest topic on my mind.
Yes, and of course, and if you show up with a new balance sheet or as a new player, you're going to get shown a lot of opportunities, one presumes. Be a healthy place for submission flow. People will be wanting to talk to you, wanting to show you things, so you get opportunities to see a lot of things, and obviously you don't have to write them all.
Yeah, I think as a new balance sheet coming in, the clear challenge is whether you have $500 million or $1 billion balance sheet or even higher. That's really the bare minimum to be approved by reinsurance ceding security committees. So are you an approved security, yes or no? I think $1 billion gets you there. I think 500 million doesn't. So that's one challenge. On the other hand, there's not many reinsurers, and counterparty credit constraints are a real topic at ceding companies, and therefore a new entrant would be probably very welcome. The key is obviously to just manage your line sizes in line with the size of your balance sheet, be really thoughtful about your portfolio construction, and make sure that you're a long-term option for companies. And I think I agree with you. I think new entrants should have a chance to be really successful in the casualty space.
One of the other models that seems to be emerging, this follow form underwriting that we're seeing of capacity provision in the London market, syndicates and businesses specializing in fast follow, smart follow, tracker style portfolio management and capital provision, and certainly not front-end underwriting. It's portfolio-centric underwriting. Good on the expense side. Obviously, you have to pay quite a lot of ceding commission, but certainly on the your own general administrative expenses, again, you down to a single-digit number of employees a lot of the time, writing hundreds of millions of dollars of business. Does that appeal to you? Do you think that's something that will have a long-term future?
Well, I think first principles, if I rewind back to the start of my career in reinsurance, 2001, GE Francona Re, Munich, one of the first things I learned, maybe day two, is automatic capacity is bad, obligatory capacity is bad, don't give up the pen. One of the first things you learn. I think over that 25-year period, that's partially been disproven. And I think the fear has been reduced in participating in those types of structures. I mean, there's no doubt that your distribution is more efficient if you play there. Yeah,
and you're getting much better data than you used to. It was just a stab in the dark. And that's probably one of the reasons why, of course, someone who's been around as long as we have, those reinsurance MGAs, there used to be a lot of them maybe 30 years ago. There were quite a few in London anyway, and of course, none of them ended well. That's one of the other reasons why.
Well, I was going to get to my big however, which is, so first of all, I think that's more of a primary play. I would suppose that most of the brokers have their own facilities by now. But reinsurance is much tougher because it's a fund of funds sort of situation. I think the data quality you're going to get is not going to be as good. And I would still expect most underwriters are going to want to stock pick their way around their own strategies. So do I think there's a place in the market for structures like that? Yes. I still think on the reinsurance side, it's going to be a smaller proportion of one's portfolio and done on a very specific basis. But I think the stigma around doing something that's more of an index play, it's more accepted than it was 25 years ago.
Yeah, particularly when the index is doing just fine. Thank you very much.
Yeah, not everybody outperforms the index.
For every outperformer, there's probably likely to be an underperformer in equal proportion, isn't there? But also, yes, one of those things that would mitigate against the reinsurance MGA would probably also be those security committees, wouldn't it? Well, the ones with the very long memories also would say, is this really acceptable security? Am I really going to cut through to get to that capital when I really need it? This is my balance sheet protection. This is fundamental to me. Maybe I'd rather be talking directly to the person who has that balance sheet rather than someone who's an agent on their behalf.
Yeah, I mean, you've had many guests on the podcast that talk about the importance of relationships. It still matters. I think having direct dialogue with your counterparty is critical. And just knowing that you're going to have consistency and supporters long term makes a big difference.
And knowing that, yeah, they've got the cash in the wallet and not somebody else. So you're actually talking to them directly. I suppose there's a fundamental comfort in buying reinsurance from someone who has the money.
Exactly.
Is there anything else we should be talking about, Steve? I think we've covered all the things I wanted to talk about. Is there anything you want to add?
Well, look, thanks for the invitation. I was hoping that I was going to be a guest of the podcast, having announced we had raised the capital. It didn't work out this time, but it's been a tremendous experience. And for those out there that have not done anything entrepreneurial, I would recommend it at some point. For me, I was a late bloomer, took it on later in my career, but it's been a tremendous experience with great people. I've certainly learned a lot, and I appreciate you having me on the show to talk about the failure, not the success.
Well, no, but thanks for that, because yes, you don't get scarred and bruised if you don't put yourself in any kind of danger, but also you don't get your rough edges knocked off you either and sort of sanded down unless you get outside and try and do this. And also, it's something that I think is really interesting is, of course, how often does anybody, I mean, even the most experienced CEO, how often do you actually go and raise capital? It's not very often. You know, it's a once a decade thing, even for the most prolific entrepreneur. So it's really not something that anyone does very often. So it's always going to be a new experience, and it's always going to be slightly different every time you do it. And you're never likely to do it that many times that you're going to learn how to do it perfectly. I really appreciate you coming on the show. Anyway, you don't look too bruised or too jaded or too scarred, Steve. We'll have you back on the show in your next guise at some point very, very soon, I'm sure.
Great. Thank you so much.
Then, yeah, we'll definitely have you on. So I've got you booked in for whenever that is, whatever your job title says then.
Sounds good.
Well, I hope you enjoyed today's episode. If you did, don't forget to subscribe or leave a like or a review or recommendation on whatever podcast platform you used to access this program. These really help get the word out. Before we go, just a quick reminder that advertising slots are available here and in other places in the Voice of Insurance podcasts. Podcasting is the fastest growing medium and attracts a high quality audience of key decision makers. It's also an intimate medium where you, the listener, are right in the room with me and the interview subjects. Needless to say, that means it's a great way of getting your message out directly to an audience because you know you've got their full attention. It's also very cost effective. So get in touch with Mark at thevoiceofinsurance.com to find out how you could be speaking directly to the industry. The Voice of Insurance podcast is produced in association with Advantage Go, enabling enterprise-scale underwriting through a single pane of glass. Voice of Insurance is produced by me, Mark Gagan. Music was written by Anna Gagan and produced by Carlos Gagan. Check out more podcasts and written comment pieces at www.thevoiceofinsurance.com.